Hi, everyone, and welcome to our Spring 2024 Roundtable event, Creative Strategic and Financing Solutions for Life Sciences Companies. As those of us who have advised CEOs and boards in the life science sector know, raising capital in today's market is an uphill climb in capital letters. Today, with the help of four seasoned FLG partners and life sciences CFOs, we're going to explore the challenges of how both smaller early stage companies as well as larger, more established players can choose the right timing and make the right decisions about their strategic and financial paths to success. So today our panelists include Linda Rubinstein, Andrew Levitch, Mark Murray, and Patrick Nugent. Each of these partners brings decades of experience in the life sciences sector, as well as a strong track record with both raising capital and executing transitions from M&A, exits to IPO. Now, over the course of her career, Linda Rubinstein has raised more than $5 billion in private and public market funding and has generated more than $1 billion in realized value from M&A transactions. Andrew Levitch has led numerous teams in the biotech, medical device, diagnostic, and digital health sectors, from Fortune 50s to venture-backed startups, and has been an advisor to Merck's Global Health Innovation Fund. Mark Murray has helped clients for over 3 decades with their corporate, financial, and strategic needs. He has raised more than $2 billion in equity financing, $600 million in debt financing, and managed M&A transactions in excess of $28 billion. Phew, Mark. And Patrick Nugent has extensive experience at medical technology and diagnostic companies at both their developmental and commercial stages, helping them to raise capital, complete strategic and financial planning, and manage investor relations. So welcome, panelists. Let's begin our conversation. So we're going to start our discussion by first exploring some of the latest key dynamics and trends currently at play in the life sciences sector. So let's start with Patrick. I know, Patrick, you've spent much of your time in life sciences in the diagnostics, med device, and med tech space. So what are you seeing in terms of trends in life sciences financing?
Thank you, Doreen. In review of the latest US funding research, at a macro level, we're seeing lower levels of cash on hand and continued challenges for many companies in fundraising, including longer timeframes to secure equity financings. But on the positive side, company valuations that were depressed are now improving. And we're also seeing very healthy, robust financings in equity fundraising, both for venture capital investors as well as for healthcare companies. So let's look at the data around these 4 trends. Firstly, cash reserves are tight. As of the end of 2023, 43% of biotech companies with a market cap of more than $100 million, over a third, or 36% of these companies, had less than 1 year of cash in hand. On a more positive note, there was very robust fundraising for both healthcare companies and venture capital funds in 2023. $43 billion was raised by US healthcare companies, primarily for late stage, about 52% of funds raised, and early stage companies, about 36%. And for US healthcare venture capital investors, had their 3rd best year in healthcare fundraising, raising a total of $19 billion. Thirdly, company valuations are also beginning to rebound. Valuations for private companies peaked in the last quarter of 2021 and continued to fall through the first half of 2023. But in the second half of 2023, valuations started increasing again. And finally, a 4th trend from the data, raising capital is, in general, taking longer. First, there's a longer timeline to complete fundraising. In the past, private rounds of financing would take anywhere from 3 to 4 months to complete, but now it takes closer to well over 6 months to complete. Investors appear to be increasingly selective and are completing more extensive due diligence prior to investing. And the average time between equity financing rounds has also grown from an average of 1.5 years to over now 2 years when you compare the first quarter of 2022 to the fourth quarter of 2023. So what we see here is that because of these trends, many healthcare companies, for example, are reducing their operating cash burn rates and also increasing internal investor bridge financings to extend their operating cash reserves. This is allowing them to drive to their next value inflection point prior to securing their next round of equity financing.
These are great points, Patrick, as we see so many of our own FLG clients, right, dealing with these issues. In fact, just yesterday, I had a call with a potential client on these very issues, how to reduce their cash burn, but keep their critical programs going. So great information for our audience. Thanks, Patrick. Now let's turn to Andrew. So Andrew, I know you've got a ton of experience working with startups in digital health. And digital health, right, was really in play over the pandemic period. What do you see happening now in this particular sector?
Thanks, Laureen. Digital health companies saw record high valuations in early 2021, and raising money at those valuations seemed easy. This funding environment led to expense growth that exponentially outpaced revenue growth. Later, as it became apparent that market was tightening, investors demanded that their portfolio companies extend their cash runways in order to enable them to ride it out until valuations came back up. This led to significant expense reductions. In addition to belt tightening as a reaction to tighter capital markets, some companies were able to obtain debt financing without the need to complete a down round. As an example, I had a client that obtained convertible financing with significant warrants at a low exercise price. While the terms of this debt effectively lowered the implied valuation of the company with the warrants, this successfully extended the company's runway without requiring existing investors to write down their investments.
Andrew, that is a completely unusual outcome in this market. So bravo, that's a great outcome. So now let's get Linda into the conversation. So I know, Linda, you've been lucky to have a number of very, very successful private and public clients, some of whom have had good access to capital for financing growth. So how do you see the haves and the have-nots when it comes to capital access in today's market? And how can the have-nots improve their chances of getting funded?
Thanks, Laureen. In biotechnology, the haves are generally distinguished by a strong investor syndicate, management team, and board. They have attractive programs, right? Ideally clinical stage with good proof of concept, a differentiated profile in terms of safety, efficacy, and/or delivery, an attractive market, and often some additional de-risking features, whether clinical endpoints, regulatory clarity, or past commercial uptake of new products. Importantly, they're looking to achieve meaningful milestones within a reasonable time frame, say 12 to 18 months. And while platforms can be in and out of favor, these criteria apply to both public and private companies. The have-nots can improve their chances of getting funding by articulating a well thought through business plan that involves spending wisely to get to key milestones, maybe being open to take some dilution in order to get validating investors or an adequate bolus of capital, and pursuing alternatives to equity funding to bootstrap the company to key inflection points.
Those are all great points, Linda, for companies who want to position themselves in the very tight capital markets of today. So thank you. Now we're going to switch to our second topic and look at how companies can extend their cash runways while they seek financing for growth. So let's start with Andrew for this topic. Andrew, I know you've worked with many early stage VC and private equity funded life science startups. So these companies are constantly chasing capital to fund growth. For example, for product development, marketing, making key hires, you name it. So what are the best ways management teams can make the right decisions about when to make these critical investments versus conserving cash?
Laureen, this is a topic of conversation with many of my clients. Most life sciences companies have to spend significant amounts of money prior to generating revenue. As a result, every spending decision needs to be prioritized with that in mind. A few recommendations here. Companies need to constantly ask and answer what investors will want to see in order to invest. They should spend money on activities that will do the most to advance the company to those inflection points. And they need to carefully evaluate different ways to get there. For example, adding fixed costs versus variable costs has both short and long-term implications. Finally, while every company should plan for success, when spending at-risk dollars, companies should consider what they should do concurrently in parallel versus sequentially. Many companies will need a cash infusion prior to meeting all the expectations of potential investors. I've seen a combination of smaller equity raises and an increase in equity financings with tranched rounds to overcome cash shortfalls. Additionally, some companies are relying on insiders to put in money to get to their next inflection point.
Those are great observations for the audience, Andrew. Thank you for that. We're going to turn again to Patrick. And when looking at cash flow sources and uses, it becomes imperative, right, guys, as a CFO, to put a stake in the ground around the timing of cash break-even performance and milestone achievement. So on that, Patrick, can you give us some examples of how you help companies build these scenarios so they can successfully pitch, right, to investors and better plan for their futures?
Laureen, this is a very topical question. There was a period of time not too long ago when the mantra was sales growth at all costs. And there was plenty of available funds to feed this insatiable appetite for growing companies. But the tide is changing around sales growth at all costs. This is being driven partly because of the lack of availability of funding to support these business models. However, it is not a one-size-fits-all situation here. There are numerous examples of public companies in healthcare, for example, in cancer diagnostics and diabetes, that require significant sums of funding to drive to an inflection point, profitability or capital break-even. These companies are targeted at diverse and very large addressable markets, so available funding for these high-growth technologies is readily available. At FLG, for private life science companies, we typically routinely undertake scenario planning for our clients that provide bookends for long-term financial plans that span at least 2 to 3 years in the future. These analyses will typically include a conservative, moderate, and aggressive revenue growth plans and investment plans, realistic break-even points, and related operating cash burn rates. These scenarios provide important data points for a holistic and executable company financing plan, but it's also a funding plan from the standpoint of the executive team, board of directors, and also the investors. As a CFO operating today's capital markets, you have to ask yourself, is funding an aggressive plan feasible given the complexities of raising capital and a tighter IPO and M&A environment? What I see is that companies today are focusing more on what I like to call measured growth versus growth at all costs. These companies are very effective in managing the operating cash burn, cash preservation, and getting creative with their financing solutions.
You know, I love that term, measured growth, because it's such prudent guidance today for CEOs and CFOs. So I thank you, Patrick, for that. And I think it captures perfectly, right, the strategic mantra companies really do need to follow in today's markets. So now what we're going to do is move to our third topic, which is creative financing solutions. And we're going to bring Mark Murray into the conversation. So Mark, finding creative financing solutions for life sciences clients is, as you know, one of our fortes, right, at FLG. And I know you've got some great recent stories about strategies you've used in these tight capital conditions to generate funding. So tell the audience about some of those.
Well, thanks, Laureen. Let me share a couple examples of private medtech companies successfully obtaining financing during these more difficult times of fundraising. My first example is a private medtech company that was in its early commercial stage of development, but was also in the middle of a pivotal clinical trial. Although the company had sufficient cash runway to fund its clinical trial, it wanted to raise additional capital to accelerate its commercial opportunity. We knew if we went to traditional VC investors, we would have a difficult time with the valuation, given both the tight market conditions and because the company had not reached a major milestone since their last financing. Therefore, our strategy was to use an inside term sheet and only market this opportunity to strategics. The result was a successful financing led by both the insiders and a new major strategic. We achieved a significant step up in valuation and increased the size of the financing by 30%. My second example of a successful and creative approach to financing is another private medtech company that was in its pre-pivotal stage of clinical trials. Our initial goal was to raise enough money to fund this initial clinical study, and then off that data, raise additional financing to fund the subsequent pivotal study. However, when testing the waters with investors around this strategy, we quickly learned that although many were interested in the opportunity, they asked that we come back to them once we actually had the pre-pivotal clinical data in hand. Based on this early feedback, we changed our strategy entirely, targeting funding for both our pre-pivotal clinical study and our pivotal clinical study concurrently, essentially increasing the funding target by twofold. The result was a successful financing that featured a large crossover investor as lead and a structure that included an upfront round as well as one tranche milestone. One final note on the use of bankers. In both of these examples, no bankers were used. I often counsel CEOs and boards that bankers at this stage of financing are typically not needed. That said, this is the time to build relationships and share knowledge with them that will be beneficial to both the company and the banker in the future.
You know, you bring up a great point with regard to use of bankers, and I completely agree with you, Mark, that there are times when you need to use them, and there are times when you actually don't need to. So I think you've given our audience some great information. So now let's get back to Linda, and now bring Linda back into the conversation. So many biotechs, as you know, Linda, being a very capital-intensive sector, feel that they rightly need to leverage investment bankers for access to capital through the public markets. So what are some of the key strategic decision points around when to pursue this path and how bankers may add value here?
Absolutely, Lorraine. When to go public is an important decision point. Most public biotech companies see an increase in available capital and a broader range of financing alternatives relative to what they would have as a private company. Going public too early, however, can be a showstopper. For example, in 2020 and 2021, many early stage preclinical companies that went public didn't have the programs or data flow to sustain their valuations. They've been having a hard time for the last couple of years. The route to go public is also a major decision. For example, a regular way IPO, combination with a SPAC, or reverse merger into a fallen angel. SPACs used to be hot a few years ago. Their popularity has plummeted, though, because they are expensive and also because of SEC regulatory changes to try to rein them in. Choosing which banks to work with is an important decision. In nearly all cases, issuers need to use investment banks to go public. And the lion's share of financings for companies that are already public, whether they're PIPEs, underwritten offerings, ATMs, etc., are executed by investment banks. It's important to be judicious in selecting the investment banks and in planning the financing. Beyond hiring the banker, the management team should expect to contribute to putting together the investor syndicate and to structuring the financing.
So Linda, you mentioned structuring the financing. So for our audience, can you tell us what you mean by that?
Sure. A structured financing often means adding bells and whistles to a common stock offering. Two examples are providing warrants or giving a ratchet, so investors receive more equity if the company later issues shares at a lower price. In recent quarters, multiple public companies have executed successful PIPEs with warrants, where the warrants were exercisable only for cash at a premium price and designed to provide additional capital if the issuer hits pre-specified milestones. In most cases, these PIPE with warrant deals have been favorably received. In contrast, many small cap companies have engaged in very dilutive financings with investors who focus less on the underlying biotech business and look only to the structure to provide the value. These structured financings can weigh down the issuing company for years.
You know, thanks for that information, Linda. Very instructive for the audience. So now let's turn to examples, right, of specific types of creative vehicles and deal structures that I know all of you have helped plan and execute for your clients. So let's check in with Mark now. And what are some of the, what we call out of the box or non-traditional ways you've seen used by companies recently to access capital?
So recently, I worked with a drug delivery company that was ultimately acquired by a big pharma company. The company was financed early on by investors who were not the typical life science investors, but who had a passion for the opportunities the company was pursuing. This allowed for less pressure on the company's valuation. The next round of financing was done via a series of convertible notes from high net worth investors who also did not have a background in the life science area, but again, had a passion for the solutions and treatments that the company was working on. Finally, we engaged a big pharma company in an equity round, which was tied to an option to later purchase the company. We created 2 equity series. The first was for the big pharma companies whose shares were valued at the purchase price. The second equity was an exchange for the convertible notes from these high net worth individuals, but at a fraction of the big pharma valuation. The big pharma equity round provided funding well beyond their option period, so the company would be funded far into the future if the big pharma did not acquire the company. The end result here was that the company did end up being acquired by the big pharma company. A substantial amount of the equity funds remained post-acquisition and ultimately flowed to the top of the waterfall, and those proceeds were shared with investors.
Those are great examples of creative approaches to financing. Thanks, Mark, for that. Let's turn to Patrick. Patrick, what have you seen when it comes to creative approaches to financings in the life sciences sector?
Thanks, Lorraine. Yes, I know one client who developed a financing solution, which I thought was very creative. The company's healthcare technology is widely endorsed by the medical community. So our client decided to approach the many physicians who understood the value proposition of this medical technology. The company ended up raising a very significant amount of funding from thousands of doctors utilizing convertible notes. This financing was completed under a section SEC ruling, 506 ruling. The resulting funding enabled the company to rapidly grow from $0 to $50 million of revenues within a 3-year timeframe. So I think this is a great example of a company who understood that doctors were the greatest advocate for their technology.
You know, from my point of view, Patrick, that's amazing, because in my own experience, I've generally not seen doctors being the strongest of investors. So bravo to you and the team. That's an amazing outcome. Andrew, what has your experience been?
So I would point to 2 other examples when it comes to creative financing opportunities in life sciences. The first is grants. Grants are a great source of non-dilutive funding. I have a client I worked with that funded the majority of their R&D with grants. This has enabled them to advance to early stage commercial with very little dilution. The second is out-licensing. There are many creative ways to out-license an asset that enables the out-licenser to retain a significant portion of the asset's value. For example, I had a client that out-licensed a phase 2 compound. They limited the field of use to specific indications in the US market. This enabled them to retain sufficient value, but also have a path to fund their phase 3 clinical trial. Eventually, they successfully sold the company.
Thanks, Andrew, for that. And finally, Linda, what about creative financing vehicles that you've seen work in biotech?
Well, one thing that's important to do in many situations is to cultivate multiple financing sources, such as equity, pharma licensing, royalty interest, etc. This increases optionality and enhances an issuer's ability to minimize the cost of capital. Revenue interest financing or royalty financing is one option that's gaining traction for late-stage clinical biotech companies. There are dozens of investors who invest in biotech revenues by buying a royalty strip or a revenue interest, which is like a synthetic royalty. Most royalty investors are willing to invest only after the underlying biotech product has been approved, or at least has registrational data to support an FDA, BLA, or NDA filing, or maybe to finance a phase 3 trial and a new indication for an approved drug. But there are a growing handful of royalty investors who will finance phase 3 trials and do so in size. And then to echo and riff off of Andrew's comments, one early stage client of mine funded all preclinical and IND-enabling R&D through a combination of grants and the Australian R&D tax incentive, which provided cash rebates for certain R&D spending in and even outside Australia. That client raised its first equity round only when it was ready to start phase 1 clinical trials, which it planned to conduct in Australia.
Great information, everyone, with regard to creative financing solutions. So that's terrific information for our audience. So now, guys, let's turn to our last and probably most favorite topic, which is when to pull the exit lever through M&A. Let's start with Andrew. So a key decision, Andrew, at all life science companies from an investor point of view is when to stay the course and continue to fund the growth needed to reach clinical milestones versus choosing to exit via M&A. This also gets into the key questions, right, of valuation and pricing. So Andrew, how have you seen this play out in practice?
Laureen, sometimes the saying, a bird in the hand is worth two in the bush, applies to life sciences companies with an opportunity to exit via M&A. There are many hurdles on the way to product approval and gaining commercial traction. And as a company crosses each hurdle, their valuation increases. However, there are often opportunities to exit via M&A along the way. When thinking through this decision, a company must take into account the execution risk remaining and the projected valuation increase if they successfully navigate all of the risks versus the valuation of an earlier exit via M&A that eliminates these remaining risks. I have a client currently evaluating this. They have worked hard to gain the attention of potential acquirers and have attracted interest. If they continue to advance independently, they have to take all of the necessary steps and risks to go from early stage commercial to full commercial. These execution risks include, but are not limited to, the need to build a successful commercial team, the need to obtain full reimbursement from payers, gain guideline inclusion, navigate potential competitive threats, and they have to develop a realistic point of view around their potential market penetration. Companies need to understand that in order to go it alone, they will need to raise additional funds and factor in dilution for existing investors. And they need to correctly assess the increase in value for the company, assuming they successfully navigate the risks and hurdles in front of them.
Great pointers for our audience. Andrew, thanks so much for that. Turning to Linda. Linda, how do you see this issue of when to exit via M&A differing across the diagnostics and the biotech subsectors?
Well, to start, I should note that biotech, diagnostics, and other life science companies use the same M&A calculus that Andrew just described. Does the anticipated higher payoff down the road more than offset the additional dilution and risk from continuing to run the company, compared to the payoff from selling now or at any given time? So for biotech companies, key inflection points are often after the first clinical proof of concept, before registrational trials, after phase 3 data, and before BLA or NDA submission and launch. Many potential acquirers prefer to wait and pay more for a de-risked asset down the road. BD or licensing also factors into the consideration of when to exit. Does the biotech or diagnostic lab or medical device company need a larger partner to help with development? For example, to design and enroll global phase 3 trials, or to help with commercialization? For example, a drug targeting a concentrated market addressable by a small specialty sales force may be tractable by a smaller biotech company, unlike one targeting a large market and requiring a major commercial presence. If so, the smaller company must decide whether to try to partner or to sell. Of course, this calculus applies in reverse for the potential licensor. The large company will consider the cash outlay, earnings impact, the probability of success, as well as the nature of the business opportunity, such as the pricing, potential margins, competitive profile, and patent or regulatory exclusivity. While diagnostics companies can have earlier revenue, they generally command lower exit multiples and can be harder to monetize than therapeutic companies. Differentiated diagnostic tests require clinical validation to be adopted in the various guidelines and to get reimbursed. And these trials take time and can be expensive.
Thanks for that information, Linda, for the audience. And turning to Patrick and Patrick's expertise in medtech. Patrick, what about M&A timing and considerations for medtech companies? What does the data say?
Thank you, Doreen. In reviewing M&A transactions for medtech companies over the past 10 years, there are very interesting observable trends. This data compared M&A transactions for medtechs at different stages of development, post-clinical trials, post-FDA approval, and different top-line revenues, less than $5 million, $5 to $25 million, and greater than $25 million. Interestingly, the data shows there is no appreciable incremental M&A value for companies in the middle size range at 5 to 25 miles of revenues. In other words, historical M&A transaction data suggests that there are two inflection points for the M&A decision on medtechs. The first is to initially sell after FDA approval or at minimal top-line revenues up to $5 million. And second, after investing to grow top-line revenues to more than $25 million in revenues, if they want to maximize their M&A transaction prices. Naturally, this rule of thumb does not hold true in all cases. Each company faced with an M&A opportunity will be different in terms of specific medical technology, size and composition of the market, the universe of likely acquirers, and how an acquirer gets comfort around commercial risk. It will also depend on acquirer's business needs. For example, the acquisition may need to be accretive to the bottom line of the acquired company within a certain time horizon. This demonstrates why all companies need to choose their timing around M&A very, very carefully.
Great information for those in the audience who deal with med tech and the med device sector. So thank you for that, Patrick. So finally, Mark, turning to you, I know you have such deep experience working with all kinds of life science companies on the M&A front. So what is the strategic and tactical advice you counsel companies when they are contemplating M&A?
From a strategic perspective, I tend to focus on three key items. The first is the investors. What do they want and how much more capital could they continue to invest given how much they've already invested, as well as what is needed to get to the next major inflection point in the company. The second group is the management team. What do they want? Are there any significant leadership changes anticipated? And what is their general ability to execute the business strategy given the capital and competitive environment? And then the third area is competition. Can the competition be potential acquirers? Is the competition substantially more competitive with its commercial capabilities? And what if the company misses out to one of those competitors? Once we have the strategic understanding of our investors, management, and competition at the company, I find it useful to run some analytics, a waterfall analysis in a what-if fashion, and compare these results if we sold today versus not selling today, and showing how much more capital or dilution would be needed and how much more growth in value would be needed to just equal under both scenarios. For example, you might find an investor who could make $100 million today via M&A. However, if they turn down the offer today and wait for an exit in the future, given the additional capital and dilution required, this might require a 30% increase in value just to maintain their $100 million. Is that feasible given all the risk and the capital requirements? To summarize, strategic input from investors, management, and competition combined with the tactical analysis will generally lead you to a better go, no-go M&A decision.
Thank you, Mark, for those insights. Very, very helpful to our audience. And at this point, this concludes the formal section of our workshop. And thank you, panelists, for participating with us today. I think you shared such critical learnings and insights with the audience. So we have some time, and let's go to the chat room to see if there's any questions from the audience. So one question that has come up, not necessarily in the chat room, but one that we have talked about is, what about the use of debt financing for life science funding? Mark, do you have any thoughts about that question?
Historically, I've done a lot of debt financing, but I will say that generally, I'd like to go to that as one of our last needs if we have, because depending on the company's situation, what happens later on might be more challenging for the company to execute their plans, given all the debt requirements and covenants that typically go into play. So I think each situation that you have with a particular company, you have to evaluate what you think the future might be, and then determine if this is the right time for debt.
Got it. Thanks for that. Another question that we all kind of wonder about, right, is the IPO forecast heating up in life sciences? Linda, you being a public company CFO currently, you probably have more than others a great idea with regard to that. So what are your thoughts there?
I love to follow the IPO market. It's an interesting and wonderful bellwether for the rest of the sector. And, as of the end of Q1, there had been, I think it was 8 companies that had gone public. In any event, a significant number that were out there testing. Unfortunately, a handful have done really well, and most of the rest have not, suggesting that it's more challenging. What does it mean to go well? To go out, investors in the company typically say that they're willing to backstop the entire IPO. And then, companies have built demand based on going out and talking to investors, doing test the waters meetings. And depending on what happens, those investors may or may not materialize to fill in the book. And then, of course, there's aftermarket performance. So I think things are still a little bit rocky in the IPO market. Bit of a mixed.
I would completely agree with you. Andrew, did you want to say something?
I was on mute. I had a comment on the debt financing and started talking, but was on mute. So I think it's important to separate convertible debt from venture debt as well. So on the convertible debt side, that's an effective use, especially in the tight capital markets, to be able to bring in financing without the same kind of painful end result as venture debt could have on the company with the burden of that debt.
Thanks for that. That's great. Getting back to that IPO comment about is it heating up or not, I think Linda is right on. Do any other panelists have any comments on that question before we go to our last question? Okay, so I'm going to jump to a question that I think a lot of people are asking, like, what about artificial intelligence or AI use in life sciences? So Andrew, Patrick, I think I'm going to start with you, Andrew, and then maybe Patrick, you might want to add your 2 cents, so to speak, on that question.
Sure. I would separate this into 2 categories. One is companies that are using AI and algorithms to actually answer questions scientifically, whether it's in the drug discovery process or, managing, all of the data that comes through. And I think it's nascent now, and companies are really getting engaged in learning it. The other one is around using AI to become more efficient in the business itself. And an example there is someone had a clinical protocol all developed, and they wanted to turn that into a presentation and was able to input that in and come out with a presentation to be able to talk about the clinical protocol. And with very little editing to that, that saved quite a bit of time. I think this is early stage for both of those, and a lot to come over time for sure.
And Patrick, what about you in terms of AI insights in the med device sector? Any thoughts?
Yeah, I echo some of Andrew's comments. I think also it's early stages, but it's easier to put into 2 different buckets: efficiency versus how is the business utilizing that technology to improve their business. I think the efficiency piece, there's some AI that's used, for example, for accounts payable function, so that it sorts correctly, bills are coming into the right GL accounts and making that more efficient. There's also companies who are trying to use AI to perfect revenue recognition. And to me, that's incredibly important and helpful. But I think there's so many nuances to revenue recognition that I think there's a long ways to go to actually be able to perfect those nuances, to apply those rules for revenue recognition. But these are the things that companies are looking to go after to make the accounting finance function more efficient. The second is you're finding that a lot of companies are using AI in their pitch decks. And some of the AI, quite frankly, is probably algorithms that were used a long time ago, but everyone wants to put that AI, banner.
AI speak, right?
Yeah, buzzword.
Which
exactly.
makes perfect sense, but there are companies who are really truly using it. I've got a telemedicine company, for example, who has enormous amounts of data. And so you're trying to, for cardiac patients, you're trying to figure out if I have, a respiratory rate of X or an SVT or level of Y, what does that mean in terms of triangulating that data and taking massive amounts of data over time to see, what are the early warning signs you should watch out for prior to some sort of event happening with said patient. So I think it's the early innings, as Andrew said, but but I think there's some real excitement around how do you take these vast amounts of data and sort of crunch all this data into usable information. And I think we're probably at the early stages, but I think over the next 2 to 5 years, you're going to see some massive growth around sort of software and how we manage this huge amount of data that's going to be thrown at us. So I think it's a pretty exciting actually.
So I think that is the last of our questions. So again, I want to thank both our audience and our panelists. Great, valuable insights from our panelists today. So again, thank you. We hope our audience can join us again for our FLG Partner CFO Insights, fireside chats, and other roundtable panel events that we put on. I think we put on about 3 to 4 every year. And this is part of our FLG Partnership Leadership Series. So with that, thank you everyone for joining us this morning. Bye now.
Bye.